Hello, everyone. I hope you can hear me well. I'm Nicola Limodio from Bocconi University. Sadly, not with you, and it's a great pity because there are many economists and experts I really admire in that room. So pity not to be there, but I'll try to do my best from midnight in Paris, where I am right now, as I gave a talk at CPR today for the symposium. Same paper, yay, make me energetic. So this is paper on mobile money, interoperability, and financial inclusion, joined with Marcus Brunner-Meyer at Princeton and Lorenzo Spadavecchia, PhD student at Bocconi, also visiting Princeton. And this is a paper on mobile money. Many people in the room do not need any presentation on that, so let me go straight into it. It's the most widespread digital payment system, and it has effects beyond payments. It affects risk sharing, remittances, lending, and savings. And many people have shown great effects on it, from Tabnit to Emily and many others. We know a lot less about, while we know a lot about the effects of mobile money, how mobile money changes the behavior of people, we know less about the financial institution behind mobile money, which is the mobile money company. And that's what this paper is about. In particular, we will be studying the role of interoperability, which is basically a competition enhancing policy that facilitates payments across platforms. And the research question is very simple. How does interoperability affect the behavior of mobile money companies and, as a byproduct, financial inclusion? So there are many frameworks potentially out there. Ours is very data-oriented. What we will highlight is the existence of a trade-off between competition between mobile money platforms and financial inclusion. This trade-off emerges from the fact that the mobile network company and the mobile money company are vertically integrated, are basically one company. I'll show you very clearly later. Our identification comes from the staggering of interoperability across African countries and operators, and we have two pieces of evidence which are new. First, evidence on mobile money fees, which was previously missing. Second, some points on the regulation of mobile money. And to clarify the vertical integration I mentioned earlier, to use mobile money on your phone, you need to have a mobile network connection. Now, there is vertical integration. It implies that the operator you have on your mobile phone, on your network, is the only one you could use for your mobile money transaction. Now, this is going to have at least two interesting effects. First, that you can be charged very high fees on your mobile money transaction since you're locked in this vertical relation. However, the mobile network operator can basically internalize the externality and use the proceedings from the high fees to install a large network of towers. So interoperability here is going to be a policy that does kind of unlocks the vertical integration so that you can use multiple, at least in principle, multiple mobile money platforms. And this is going to make mobile money companies compete on fees and lower their fees, but this will come at the cost of a smaller tower network and therefore less signal out there. And to recap the paper into pictures, I'll tell you how we get this data. This is the average fee on a mobile money transaction. I'm sending a payment to Paul or to Lara. We are both on the same network. The average fee across all African countries, simple means, nothing fancy, no fixed effects, nothing, is 4% and is quite stable over time. If we split between operators that become interoperable and those that don't become interoperable, we see that non-interoperable operators keep charging 4%. Those becoming interoperable, fees drop down to 2%. Similarly, if we measure coverage as the percentage of a district that is covered with mobile network coverage, this is on average 90% in Africa and quite stable over time. But if we split between interoperable districts in interoperable countries and districts in non-interoperable countries, we see that non-interoperable converge to 100% by the end of sample, while those non-interoperable converge to a lower plateau of 80%. So this is the paper in two very simple, broad, descriptive pictures. We're going to add fixed effects, staggering a bunch of these on top, but these are the main findings of the paper. So now, let me skip this in the interest of time, and let me try to deliver one important message here. Why do we see signal and towers going down? This goes to the economics of the problem here. If we think that towers are a sunk cost, then we shouldn't observe any decline in towers. In fact, towers are typically sunk in most high-income countries since they were paid for by governments. However, in most low and middle-income countries, in Africa in particular, many towers are off-grid, not connected to electricity, or in areas with unreliable power. This implies that these towers are typically powered with diesel, plus the cost of security, cost of maintenance. As a result, these towers are really a variable cost in many instances. As a result, as we as operators see a negative shock to the marginal revenue of their operations, they will be cutting towers that are no longer viable. And therefore, we are going to see a decline in signal and tower. So let me skip literature, and I apologize with many of you who are cited there and are cited in the paper. I just want to tell you one, I think the most creative part of the paper. We have many interesting data sets. You can find them in the paper. What I'm most proud of is the data on mobile money fees, which was not previously available, and there was, kind of some creativity that with which we constructed it. So we built data on mobile money fees for 129 companies in 42 countries using Wayback Machine. And other data we buy from GSMA, or we find it from central banks, IMF, World Bank, quite standard. But in a nutshell, you can find data on mobile money fees going on the websites of companies. This is MTN in Uganda in March 2023. You can see that you can send between 500 and 2,500 shillings, paying 100 shillings, 2,500, 5,100, and so on and so forth. Now, you can see two things from this figure. First, that in this case, sending money is interoperable. You can send money to other MTN customers, or you can send to other networks. So we can measure interoperability directly. Second, fees are structured according to the value of the payment. There is a low value of payment, second low value of payment, and so on and so forth. How do we calculate the fees as a percentage? We take this 100 here, and we divide it by the midpoint of this range. And that's how we calculate mobile money fees. We throw this link into Wayback Machine, and we can build basically a panel over time for this number of companies. So I'll show you some, in the interest of time, I'll just show you some pictures. Okay, so, sorry. Good. This is the average fee by transaction bracket across Africa over the entire time period. Low value payments, basically the first bracket, second bracket, third bracket, present very high fees in the order of 33%, 11%, and 8%. And you can see that there is a decline in these fees over the value of the transaction. I'll show you that this will change as interoperability kicks in. But the average fee, 4%, doesn't tell you the fact that the lowest values are the ones that are taxed the most and are typically the one used most intensively by poor people. Now we have data on mobile money coverage, on mobile network coverage. This is a country, this is operator 1 in that country, and this is operator 2. We're going to study both operators in districts separately, and then we're going to study the union of these two and study overall network. Our identification comes from the fact that interoperability is staggered across countries over time, and that's a bit how this looks. Okay, in 2021. So, okay, I'm sorry. Zoom is slowing me a little bit down. The first specification is just a simple event study where we ran the fee by company I in country C at time T on company and time fixed effects and a standard event study windows for the median fee. We see that we can't reject parallel trends before the policy, but we can reject them as the policy is implemented. And there is a sizable decline in mobile money fees by 0.2% overall. We see that this is highly heterogeneous across the value of the payment. The lowest brackets, those that were the highest I showed you, are the ones that show the largest decline. And again, to go descriptive, before interoperability, this is how fees looked like. Every point is a company. After interoperability, basically you see two things. First, there is a decline in the average fee. Second, there is a decline in dispersion. So for the economists in the room, the law of one price applies. And remember, the marginal cost of sending a small payment or a large payment for a mobile company is essentially the same. So the second thing that we study is coverage at the district level. Same regression as before. We cannot reject parallel trend before the policy, but we see a staggering decline in coverage post-policy. And this table summarizes the previous picture. After studying what an operator does in a district, forget about the operator and look at the district, which is, there may be multiple operators. One is cutting, one is not cutting. Service may not change overall. But actually, once we study at the district, we see that coverage is also declining in this case. And that's what this picture shows you and what this table recaps. Again, I'm being very fast and I apologize for that, but I want to deliver the key message of the paper. Coverage declines, the probability that districts still have signal goes down, the number of operators per district declines with interoperability. Now, the last part of the paper, we try to, we have bits and bytes of evidence. What happens to financial inclusion overall? So we take data from the columns 1, 2, and 3 are from the global Fintech, column 4 and 5. So columns 1 to 3 are surveys, repeated cross-section, where people are asked, do you have access to emergency funds on your phone? Yes or no? Do you get remittances on your phone? Yes or no? Is your wage paid on your phone? Yes or no? 4 and 5 are coming from the IMF. These are country-level data on the number of mobile money accounts and the number of mobile money transactions. Again, with all the caveats of this identification strategy, we can see that interoperability is associated with a decline in remittances and number of transactions. And these are particularly amplified in countries where there are extensive mobile money networks. Here, on top of the interoperability variable, we are interacting this with the pre-policy size of the mobile money network. A small decline in users will lead to larger negative effects on mobile money, since mobile money is a network good. The last part I want to introduce here is about what we think about policy proposal. And again, you can think of various ways. IO models would tell us to separate a retail and a wholesale market. But this is hard to study empirically. So we try to nail this in a different way. We try to make an analogy between supermarkets and telecoms. In a nutshell, we know that there is typically uniform pricing. A paper by Della Vigna and Genskau shows that typically supermarkets charge the same price across locations with different characteristics. Well, very much the same happens on mobile network and mobile money companies. The fee is the same regardless of the characteristics of the district. However, this implies that there is a lack of price discrimination between urban areas where there is electricity and towers are cheaper to run versus rural areas that rely on this diesel generation and will have a higher marginal cost. So in principle, if price was discriminated, many of these problems would disappear. However, there is a way around this. So there are subsidies for rural telecommunications, which many countries like the US, Europe, give to operators to keep signal in poorer locations. And so these exist in Africa as well. And these recreate price discrimination because while the fee is the same between urban and rural areas will embed this subsidy on top. And so what we can show in the next slide is basically these rural subsidies help to counter the decline of interoperability in rural areas. However, this comes at reduced service in urban areas. Again, the paper will give you more about this. So I think I only have 30 seconds. So, we do a lot to try to, using the latest methods on diff in diff, we show that the decline in signal and network is stronger in rural areas and in poorer areas, and a lot more that you can find in the paper, which is, I don't want to bore you too much with that. So let me conclude and try to be on time. In this paper, we study the role of interoperability in the mobile money industry. there is a trade-off between competition and financial inclusion. And we learned that there are benefits and costs of interoperability. In particular, in my opinion, there is a financial inclusion cost of monopoly power and of dissuasion of infrastructure investment. And what I will keep working on, and I'm very excited to be part of this, even if digitally, is to keep studying the regulation of digital payment platforms, fitting in my agenda on finance and development. So thank you very much for inviting me, and looking forward to more of this conference and these events. Thank you very much.